We got some checklists there for fundamentals.
By the way, I appreciate that. I do. I do. Anyways, I'm gonna let you go. I've got a load of work to do. But by the way, how's the weather in Salt Lake City today?
Dude, we're gonna be 64 today.
Oh, I hate you.
So I mean it's a low 30s. We're in the 30s now. Like, but this is unseasonably warm. We were in St. George, which that we're dropping, like 2,500 feet in elevation, so it's a lot warmer. But it was like 80 on Friday, Saturday, Sunday. So
Cool. Well, it's all good. Well, I will
you can
then
have your snow though.
I will touch base with you tomorrow. Have a great
All
day,
right,
Brad. See you. All
see you,
right.
Professor.
All right.
All right, let's get rolling here. So we got some stuff to talk about. So last week or 2 weeks ago, I introduced a week and a half ago, I introduced a hedge. We talked about managing that hedge on Thursday. I was out on Friday, so I was looking at stuff for ghost prints in the morning, and then we had baseball games on Friday and Saturday. Amazing weather for baseball in November. We've been going down there for years. We've never had a day like a weekend like that because we usually go March and November, and because you don't do the stuff up here, right? And it's too hot down there in the summer. You don't want like 115. It's not as hot as like Phoenix or where Don is, but it's still pretty hot down there. It's like Vegas, almost like Vegas weather where Tony is. But yeah, so we had a good time. Watching my son play baseball, watching him pitch. That's his big thing. So but anyway, it's a lot of fun. Seeing my son who's a senior starts to throw a football again. I mean, gosh, the kid was in 8th grade, threw for 1,600 yards. He had some foot issues, some surgeries that were unfortunate, and could have came back his sophomore year, but decided not to. And but man, watching him throw the ball out there, 50 plus yards was kind of fun to see him because he hasn't thrown for a couple years. But anyway, let's get rolling. So we got Randy in the house, we got Rock Bro. Who else is here? Make yourself known. If you're a Ghost Print member, let me know. We got some current informers here. Tim's here, me, all caps. UWC says good morning. Let's rumble, says Rosario. All right, so we're going to talk about today. We're going to look at the volatility measures. We're going to see what they're telling us. I mean, again, this is how institutional traders are positioning themselves in terms of forward expectations of volatility, in terms of how they're hedging. We're going to talk internal versus external trends and managing the hedge. How many took the atomic hedge? I walked through last week on Tuesday, I think. I did it the week before as well. How many took the atomic hedge? Let me know. 6 minutes radio silence. Alan did? Okay, Alan, did you have a chance to roll your hedge? Depends, I guess, what. Probably didn't depend what day you did it, because I think we had a 64 strike. Alan G did good. All right. So let's kick things off with the hedge. Okay. So I laid it out on Thursday exactly what the plan was with the hedge, if anyone remembers. So we're going to go to the analyze tab here. We're going to look at SPY. Now, I kicked off the Tuesday hedge. I probably should have left in. Maybe it brought it back. I don't know. Let's see. Actually, Tuesday hedge is there. It's not locked though. That's about what the price was at the time anyway. 658. But the point is we had this 671 put, right? And so the market right now, as we look at the SPY, where are we at here? I'm trying to find my hash. We're down here at around where? We're at about 679 right now. Now notice what happened last Friday. Okay, we talked about and we priced it. And we're like, look, if the market could drop $3 more on Thursday, and it did, you had an opportunity to hedge. And then on Friday, it dipped all the way down to 661. Okay. And so the idea is on Thursday, you had a chance to roll. And guess what? On Friday, you had a chance to roll again. Okay. We're going to look at the strikes that we had, the contracts we had, and we'll kind of talk, but we're going to lay it out here just a little bit. So the point is that we're buying what strike price? We're buying a delta 30, right? When you buy a hedge, we're basically buying a delta of 0.3, roughly, right? We're wanting to hedge 30 or a third of our portfolio. We're buying a 30 delta. In this case, for a $100,000 portfolio, we bought 2 contracts, okay? We want to roll when the delta approaches 60. Now, it doesn't mean it has to be 60. We want our roll to extract a certain amount of value. Roll when you can capture, oops, $1,000. So we'll say $500 per contract. Okay. And where are we rolling? We're rolling back to a 30 delta. Oops. Roll back to a 30 delta. Now, when we talk about a delta of 0.6, we're talking about what? An in the money option, right? So we're buying an out of the money put. So if we're doing it today, the put might be down here somewhere, right? As the price falls and that option goes in the money, we want to roll it down and we want to get out $500 per contract. Okay. So that was the plan. We laid this out on Thursday. We checked it again on Tuesday. We walked through a new hedge you could have done on Tuesday, which is in there right now. All right. So let's take a look at what the hedge did. So we're going to go to Friday. Well, actually, we can't really do it. So we're going to look at it here. So again, what could have happened as the price, and we were evaluating it on Thursday, if we got to 668, okay? So if we touched right there, you could have got in the hedge I'm going to show you, could have taken out $1,000, right? And on top of that, guess what you could have done? You could have also bought back the call vertical. So you would have actually netted probably over $8, right? $8 or $800 per the whole round trip. And so Alan G, if you want to share, what was your roll? So if you rolled it, how much did you get out of it? Because we look right here, right? We sold that for $243. We bought this for $517. If you could have rolled it from $671 to $658, this is what we walked through, right? On Thursday, we were looking for what? A 501 credit. Okay, that's $5 per share, $500 per contract, and you'd actually be rolling 2 of those. Does that make sense? So on Thursday, so Alan got $1,100 on his roll. Did you buy back the call vertical? Did you nix it? Which basically does what? It takes away all of your upside risk right now. Right? Now you have smooth sailing all the way to the upside. And this is accounting for the drag of this because I don't have a roll in there. Okay. But if I lower that to 2 and I bump that in there, now we're probably accounting for it fully. Okay. So as we look at this, we're saying what? $1,100. Now, guess what the market did, right? We flattened out on Friday and we bounced yesterday. Now, here's the deal, though, right? If we look at the roll that we analyze on Thursday, we rolled it to the 658 strike. Was there another opportunity to roll? Now, here is where it gets interesting. I told you to roll when you get $1,000, right? But that's not necessarily what you have to do after you've rolled once, but it's not a bad thing. But the mark price came down here to 662-ish. So we didn't get in the money again, right? But you have $1,100, right? You have basically, Alan, if you want to share what strike price you rolled to, maybe you're down here at about 658. And if we roll over again, we'll do it again. So this is what the hedge is intended to do, right? You now have $1,100 per 100K, right? $1,100 per 100K. That's $1,100 that can't be taken away from you. So when you move into the future, guess what? You now have $1,100 to do other things. Like what? The 655. So now you got a 655 down here. Now, what if we rally some more and you've got a 655? You want something a bit higher. Well, guess what? You can roll it up. Now, rolling it up is going to cost you money, right? Or you can roll it out in time. It's going to cost you money. you just got $1,100, right? That you can use that's going to help you manage this hedge. I'm surprised only Alan took the atomic hedge. But the point is the market doesn't have to go to garbage, right? You just gotta go in the money a little bit, and you're gonna have a chance to extract some value. Even as the market's correcting, you get a bounce here. You've got now the 655 down here. That's still not bad. Right? I mean, we could get to 655 in the next week or 2 weeks or month. Okay. You still have the 2-call credit spreads. Now, that's where ideally you probably try to buy those back with your credit. Now, that might take some of your credit. You might walk with $900 instead of 1,100. Okay. But try to unwind the call side if you can. Right. And if it's on a roll, you're pulling value out. That's a good time to close it. It's for future reference. Okay. But originally we did the 697 703s. 697s are still way up here, aren't they? Okay. So, I mean, it's still way out of the money. And all I have to do is just slip a little bit or time decay, right? We don't actually move up. That sucker is going to decay. What's it trading at right now? Is originally 243. Unlock it, it's 89 cents. So you're still good, right? I mean, you can still buy it back today, but yeah, you might as well wait a little bit. Let some of that whittle down. I mean, you could buy it back for 10 cents. That'd be awesome. Okay. All we need is just roll over a little bit, let some time pass, and you're in a great position to close out the call spread, right? 697 still way up here. Can we get there? Sure. It's acceptable. Why? Because the portfolio goes up. I also said another thing as well. So when we talked about the atomic hedge, I said, look, just own GLD and NVDA, right? And the idea being is that you just hedge it with the atomic hedge. Is it possible that NVDA may go down? Yeah. NVDA goes down, we're probably seeing the broader market start to weaken. If we're looking at it today, let's look at NVDA. NVDA is down 3%. Does anyone know the news on NVDA? Anyone want to share the news on NVDA? What was announced overnight from Japan? Does anyone know? What was announced last night from Japan? SoftBank sold 5 billion Nvidia, right? That's a big deal. I mean, they usually hang on to the bitter end. I mean, they take on big losses and big gains sometimes too. But SoftBank's exiting Nvidia. Is that appropriate? I mean, Professor just talked about valuation, right? EV to EBITDA. He didn't necessarily define the EBITDA side, but that's earnings before interest, taxes, depreciation, and amortization. And if we're assessing valuation, so remember, I posted where is it? Oh, it's over here. I posted this checklist in the chat. Okay, I'll post it again here just since I'm talking about right now. Load to attach, one checklist. So this document I just uploaded it just now. Okay. This helps you evaluate growth, value, and income, right? At some point, valuation is a problem, right? The idea is that extreme valuations create extreme moves. But the reason why SoftBank's selling, it's really about this story right here, right? It's about the growth story. I mean, the fact of the matter is there is a lot of NVIDIA processors that are basically collecting dust right now, right? But yet we have this just positive feedback loop where everyone's buying each other's stuff. We're handing out credits and booking it as revenue. There's a lot of problems right now, right? In terms of you have ChatGPT that's driving the growth and they don't have the money to do anything. None of the agreements that ChatGPT has done allows them, they have the money to do at this point in time and not remotely close. NVIDIA is on the hook. They got to buy back the processors if they don't get used at some point, right? They've guaranteed it. They've really changed the game in terms of being a financing bank. They're basically the Carvana of AI, right? Carvana couldn't make as much money selling cars. They got in the financing game. NVIDIA was making money, but not enough apparently. They got in the financing game. So at some point, valuation matters for everybody. Okay. And that generally happens as the growth story begins to start to fade just a little bit. Doesn't mean it's going to go negative. It just means it's starting to fade. And so if we look at NVDA, and let's use Yahoo Finance, look at statistics here. This is was a almost $5 trillion company. But you look at these measures, EV to EBITDA. Now, why do people like EV to EBITDA? It's because it's comparable, right? A company's capital structure does matter in terms of its valuation, in terms of PE, trailing PE here. Well, why? Because there's things that affect income, like depreciation and amortization, interest and taxes, right? So some companies want to have less of a tax burden, so they're going to structure stuff to reduce their income and lower their taxes. But that means you have depreciation, amortization be a bit higher. So we start to get above capital structure, that's EV to EBITDA. So now we have something that's very comparable. Trailing PE is not comparable. Growth stocks generally demand a higher PE. Other companies, right, don't. But if we look at EV to EBITDA, we're getting above the fray of capital structure. We're incorporating debt minus cash as well as market cap here. And suddenly we have a measure we can use a general threshold. PE, you can't. But for EV to EBITDA, you can. And we're talking less than 10 would be a value stock. So if you want to put a number here, less than 10. Now, would you consider Nvidia value stock? No. But the fact of the matter is, this is an extraordinarily high number. We can take trailing PE, which is the last 12 months. Well, what about the next 12 months of earnings? The forward PE is still 30. So even if we're accounting for next year's growth as the earnings against the current price, there's still a 30 multiple here, right? Less than 15 would be a value territory for forward PE that's accounting for at least 1 year of growth. PEG ratio, 5-year expected, this is less than 1. Now that says value. But guess what? That's based on 5-year projected earnings growth. And right now, it's probably pretty prolific, right? The analysts have not yet caught up that the earnings growth may not necessarily be there. So if we come in here, I think they took it off now. Let's look down to the bottom. Current year, next year. Yeah, they just have next year's growth. Let's bring up Zacks. So we bring up Zacks, type in NVDA, and we scroll down. We look at detailed earnings estimates. We look at the 5-year, past 5 years at 75%, next 5 years at 32%. So I don't know what Yahoo's using for their PEG ratio. They used to notate everything, but for their PEG ratio, this is a PE, which is a 56 times earning divided by a 30% growth rate. It's not 0.88. So I don't know who they're using, but yeah, that did not happen there. So it's probably erroneous. But if we look here again, this is probably pretty true to form. Next 5 years, 32%. What Japan SoftBank's basically saying, I don't buy it. Okay. LNG just closed the credit spread for a total gain of $1,500. Perfect. Easy money, isn't it? I mean, isn't that the easiest, most stress-free trade you've probably done? Because it took away your risk, right? And you made $1,500. It's not a bad gig, right? And turn around, do it again. If we drop below 655, roll it again, take another 1,000 out. Okay. It's a big deal, right? To be able to understand the timing of hedging. Not that it's going to be perfect every time, but you get a couple, 2-3 rolls, like an April scenario, and you're booking like $5,000 on your rolls that you can now manage future hedges. The stress is gone, right? The stress is gone. Again, doesn't remove all your downside, but it certainly helps you sleep at night as we get certain triggers, which is part of the 90-day rubber band, right? So again, Nvidia right now we're seeing 32%. Japan SoftBank's basically, I don't buy it. I don't buy it either. Okay, I just don't buy it. $5 trillion company is going to grow there into 32% organically. It's inorganic if you're financing all the purchases from my perspective. Thanks for the help, Alan. I appreciate it. All right. So let's take a look at said 90-day rubber band, because what caused us to hedge? It wasn't the external trend. Well, why would I hedge? We're in a bullish trend. It's exactly right. You hedge because you're in a bullish trend, but you have certain internal indications that the trend is softening or weakening, right? So what are some of those? Well, one of those is the 90-day rubber band. So external trends focus on short-term trends, intermediate-term trends, long-term trends. Internal trends focus on volumes or price divergences, prints like option activity, which is a big part of that, right? Relative strength, who's leading and why, earnings outlook, earnings revisions, and guidance. These are all things that technical analysts look at. You will be tested on every single one of those, including economic data if you take the test. You have to be a professional in the industry to take it, though. Or at least to get your designation. So let's take a look at what I call the 90-day rubber band. Okay. So when did we get a trigger? So what are we doing? We're looking at the VIX. The VIX right now is down a little bit. We're at 17.5. Okay. The VIX 3M is at 20. So we pair the two together, 3 month plus 1 month, and we create a pairs ratio. This is the pairs ratio indicator. I will share my setup. It's just the style, and I'll drop it down here, but you have to do the composite symbol. Okay. VIX 3M plus VIX. Now, we did this in response to the signal we got back here on the 27th. The 3-month VIX was pricing 20% higher than the spot VIX. So you look right here, the left-hand scale, 1.2. 3-month was 20% higher than the VIX. We're currently 15% higher. So we're starting to enter a territory that starts to see expectations start to rise. Above here is extreme. Morning, Daniel. So we had that trigger, and we also had an indication. So this is basically telling us institutions are pricing an extreme rise in volatility in the next 30 days. Then we look at skew. And skew, where was that on the when was it? It's back here somewhere, wasn't it? No, I dropped to 140. But if skew is so right there, that date was October 27th. We go back to skew. All we want to see is that skew's north of 130. So where's the 27th? Is right there. We're at 148 on skew. And it was interesting, right? We had a scenario where we had some puts being bought, right? Leading into what? Earnings, right? So, and we saw this drop here, skew drop, and we saw it kind of creep up. We're at 143 right now. So skew's still elevated, right? The sell-off that we saw in the market did not change anything. What percentage correction did we get peak to trough? Bring this down here. Peak to trough, we got a 4%. So again, I'm looking for a 5 to 10% correction. That could be it, except for skew did not come off. What did the 3-month to 1 month VIX tell us here? Did we cross below 1? The answer is no. We did back here on the 16th. That's a bullish signal. This is an indication VIX is going into backwardation. And unless you're looking at a 10 to 20% correction, generally speaking, that is your low, usually within a day or two. So we didn't get down to here, right? Skew didn't fall below 130. We didn't come back to 115 to 120. The market is still very, very guarded. Should you be guarded? Probably so, right? So rolling the hedge maintains your hedge. You're just resetting back to that 30% hedge position. But if we sell off, guess what? It's going to kick in again, right? It's going to kick in again, and you're going to have a chance to roll. And you'll see that down here below 60, 6,500, 650 on the SPY, you're feeling pretty good. Peter's always guarded. I'm glad. No, I mean, there's times where we got to lower our guard, right? This year has not been one of those years. Okay. Now it's one of those scenarios where this rally off here, but we had some pretty significant signals. If you were following that methodology and hedging, you would have hedged back here. You would have hedged right here. You would have hedged February 14th. Where was that? Right here. There. Hedged for what? A 5 to 10% correction. 5% correction. 5% correction. A lot bigger than 5%. You had a chance to pull out $1,000 there, right? You had for a $100,000 portfolio. You had a chance to pull out $1,000 there. You had a chance to probably pull out maybe $5,000 there as a hedge. And guess what? You just pulled out $1,000 here. Now here's the problem, though, right? Or not, it's not necessarily a problem, but hey, you would have hedged here. Probably didn't get a chance to roll. You probably had to roll your hedge here. And then you did what? You might have had a chance to roll your hedge here. Okay. Did you give some of that $7,000 back? Absolutely, you did. Did you give it all back? Maybe. Doesn't matter. No. Right? You just had all of these hedging gains. And during the most extreme position in the market we've almost ever had after this move and then this grind, not a bad deal. And you just pick up $1,000 again, $1,500 again, right? So this is the game we play, right? It's about risk-adjusted returns, and you take the edge, the whammy, off of a 20% correction. Did we go 20%? I think we did. 21.5%. Take the edge off of that, right? You're not waiting for bear markets to hedge. You're just not, right? You have to recognize when volatility expectations are peaked. That's what we're trying to do here, right? We're hedging alongside institutions as they're hedging and as their vol expectations are peaked in the next 30 days. Man, I'm incredibly thirsty here. So Dennis, can the volatility be similar to last year when they finally took profits mid to end of December? Absolutely we can. I mean, here's the thing is that it's similarly crowded like we saw back here in December. I look at that day right there, and I've drawn this corollary before, but I look at that like December 18th. Okay. Again, we did break to new high here, but I think it's going to be much more of a two-way market going into the end of the year. Where is the money coming from? So we talked about the fact that Nvidia, it's cannibalizing the rest of the market, or was. Notice that energy's up today. Nice big move. What's oil doing? Oil's hot, a little bit higher. Is it really surging here? A little bit. I got a bearish trade in USO. Just can't quite get there. I did go out to December in this one. Just got to get it down here. Well, I got plenty of time for that to happen. 38 days remaining. But the point is that, look, I mean, we have a scenario where, yeah, we're kind of, some other stuff is kind of easing back after the big move in technology yesterday. This is falling back. What are we seeing? We're seeing a rotation. How long have these rotations lasted? Day, two? Man, I wish we could get a rotation that lasts like 3 to 5 days. Good luck. We just haven't had it. Right? If this is a rotation to energy, can it go for a week? Okay, so the problem is that at the end of the day, this has been a real struggle when we see the rotation. Now, the question is, if we see an end of year rally, can energy lead the market higher? No, it can't. It's not big enough. Can healthcare lead the market higher? No, it can't. It's not big enough. What about staples? Nope. Financials have got to participate. It's up a little bit today towards the high end of the session at the moment. But the fact of the matter is, it's going to be a tough road to hoe unless the dollar just gets smashed again. In which case, isn't that the gold trade? Right? So today we're seeing a little bit of some strength coming back in the dollar off of the high in GLD here. I'm looking for this to test 405. Now, why am I looking at that? Let me just share this with you. So yesterday, bring up the Ghost Print surveillance console. Man, we got some features. It's going to take a little more development to do, but I got some features in the in my hat we're working on. This is gonna be killer. But we're gonna look at yesterday. And I had the one-click block trade. So if you want to know the biggest block trades from yesterday, you just click that number. What is a block trade? I define it as 1,000 contracts or more. This is probably 70 to 80% of what you'd want to look at anyway. 1,500 different options symbols are coming up just using the very general filter. That's not including stuff getting filled at the ask. It's also sold, so we can evaluate stuff like spreads. Okay. But again, 1565, we've narrowed it down to 30. Okay. I'm going to sort by vol alert. Notice what happened yesterday. This was a spread trade, right? 114,000 contracts bought in one trade. They bought the 390 calls and sold the 405 calls. Now, notice that's not down here. Doesn't matter. Again, sometimes when you buy 100,000 contracts in one trade, you're going to move the market a little bit, right? They got a bad fill, which happens all the time, right? But they're buying a call spread, 390, 405. Now, my expectation is that the market grinds higher here. That gold should outperform. Stagflation environment. Gold was a big performer yesterday at 2.7%. Makes sense. There's probably a little profit taking today. But if the dollar starts to weaken, gold's going to quickly get to 405. Okay. And so again, this is one area I'm expecting to outperform going into the end of the year. Outperform doesn't mean necessarily going up. I think it's going to go up. I think the dollar is going to be generally weaker. That may help support the S&P, but it's not going to lift and really cause the S&P to really drive hard into the end of the year. We might just kind of limp. Also, gold. There is a seasonal trade in gold, and it generally bottoms in November and rallies into early next year, especially in a circumstance like this. We get the Santa Claus, we get the end of year rally, you get the Santa Claus rally last week between Christmas and New Year's. You get that wind at your back and the market just grinds it out higher, which I'm kind of expecting. But the reality is gold should outperform the S&P 500. The gold loves a stagflation environment. Weak dollar, we're going to open the government, we're going to fund it, and we're going to raise a bunch of debt. Now, it doesn't fully push off the concern of economics, right? The economic conditions are very, very hostile right now, but we're pushing through it. Market's pushing through it. The weak dollar is helping the market push through it. So we might see the S&P just grind into the end of the year, but I'm expecting in that scenario, gold should outperform. We should have a reasonable chance of getting back to prior high. So they bought the 390 and sold the 405. That's my target going into the end of the year here. Okay. So we traded its December contract, 386, 388. We're looking for a 70% gain. We get to 390-ish, we'll probably be able to get out of that. Okay. Governments are spending like crazy everywhere, but why? Okay. They have to. Well, they feel like they have to, right? Inevitably, does government spending actually lead to growth? It will lead to GDP, but GDP is not growth. Does government spending lead to growth? In actuality, the debt and deficits can be so disastrous on the economy that for every $1 spent by the government may lead to actually negative growth, a negative dollar return. So government spending does not always lead to growth. I know we assume there's this one-to-one relationship, but the reality is you're robbing Peter to pay Paul. Okay. The U.S. isn't abandoning the world, though. So we're talking about tariffs. What is Trump actually trying to do? So let's just talk about it for just a moment. So the dollar is a reserve currency, right? So the dollar as a reserve currency. Why is the dollar the reserve currency? Now, we can go back to World War II and Bretton Woods. The promise was the gold it was gold backed, right? Meaning that what? You could convert dollars to gold at a fixed price level. That's gone, right? Nixon suspended the gold window in 1971, and we got rid of it in 1973. We defaulted, by the way. right? That was a US default. We promised, right? We guaranteed a dollar convertibility to gold at a fixed price. Guess what? We also did it before. We did it during FDR's administration. I believe it was $22 an ounce. We raised it to $33 an ounce. Okay. We've defaulted again because we basically said, hey, the dollars that are guaranteed to be convertible to gold at a fixed price, we changed the price. We defaulted. We didn't default on our debt, but we did default on the dollar backing of our currency, or the gold backing of our currency. What's backing the dollar today? What's backing the dollar today? Nothing, right? There is no dollar backing. So why is the dollar a reserve currency then? It comes down to a very tax base. It's not even related to our tax base. It's a private bank. These are Federal Reserve notes. Why is the dollar reserve currency? It's kind of faith a little bit. It's because we're the biggest debtors. Okay. We are the biggest debtors, right? We borrow money from the world, right? We borrow money and what? For goods. Now, here's the problem with that, though, right? We borrow money from China, borrow money from Japan, borrow money from all of these other countries, including Canada, for goods. Now, those dollars can be redeployed for our goods, right? For US goods. Is that happening? No. We have a massive, massive trade deficit annually, right? Well over $1 trillion. So the reality is the people that are taking our dollars are not buying our goods. There is no exchange. We're basically just continuing to raise debt because why? We consume more than we produce. Okay, that says produce, by the way. We consume more than we produce. So we have to borrow from the rest of the world. They send us goods and they don't buy our goods. They buy our what? They buy our real estate, they buy our bonds, they buy other stuff. The bond story is kind of fading a little bit, right? So again, what is Trump doing right now? Is it jeopardizing the dollar reserve currency? Absolutely. Why? He doesn't want us to be a nation of debtors, right? He wants to say, look, we've got to even out the trade balance. But we also have to make our workers, which are highly productive, we have to make them competitive. That has to be done through regulation, taxation, that kind of stuff, right? So tariffs, I don't like necessarily imposing large tariffs, but he's also saying what? We want to shift the focus away from China. We want to shift it westward, and the U.S. wants to be at the center of that. Are we deglobalizing? The answer is no. I mean, frankly, if you look at Trump, and again, he's been in office for almost a year. This is actually a complaint by members of Congress that were kind of your MAGA people too, right? They're complaining right now. Why? He's doing all of these international meetings all over the world, all the time. They're saying, hey, get back to the U.S. agenda. So again, we are not deglobalizing. We're just recentering global trade. We're trying to recenter it away from China and towards the U.S. We want more people to buy our goods. Okay. So we'll see what happens, right? We'll see. Collecting $500 billion in tariffs in 1 year, right? The reality is tariffs are not a bad thing, right? Tariffs and are not inherently inflationary. And again, everyone that says tariffs are inflationary have no problem with excessive government spending, right? They have no problem with debt and deficits for the federal government. In fact, I had 2 Yale and Harvard trained economics professors in college. Both of them taught at Yale, by the way, at one point, who said there's a free lunch. We print money, we buy goods, and we send it. It's like sending a check. And if they don't cash it, it's like what? Free money. Literally, economics professors saying there is a free lunch. We do not we do not value debt and deficits. They do not consider them inflationary, even though they inherently are. Right? We know through history that's to be the case. Tariffs, not so much so. But if you think tariffs are inflationary, then every regulation, every tax on a company, based on the argument, is immediately passed on to consumers. Every regulation and tax on a business is therefore not paid by the business, but paid by consumers. But that's not true either. But tariffs, or even more so, the manufacturer can bear the burden, right? Which frankly, a lot of places are right now. So we'll see what happens. But I don't see the Trump administration as being anti-globalist. They are definitely trying to say, hey, we matter, right? Trade, we want to balance trade. We want to lower our debt, at least on maybe a household level. We want to kind of shift from government spending. I'm not sure. I mean, we're not seeing any real intent to lower federal government spending. No party wants to do it right now. So we'll see what happens, right? So we'll see what happens. But right now, again, what we do know is we're going to pass a spending bill, right? We're going to redo this in a month or 2 months or 3 months, and we'll be back in the same position we are now, right? Continue resolution to fund the government. I mean, why don't we just do what Obama did? He just didn't worry about it. Well, we didn't do a budget. We did do continued resolutions, though. Okay. So we'll see what happens, but there is risk right now economically, and there is risk of trying to re-domesticate manufacturing, trying to re-center manufacturing. We're gonna basically, what is the new announcement? We're gonna build a bunch of nuclear power plants for what? Nuclear power is not even cost effective these days. Look at the power plant was built it was built in Georgia. Supposed to be $1.5 billion, and it being like $4 or $5 billion, and they can't even produce cheap energy. So I mean, nuclear is not exactly the cheapest. But again, I guess if they're gonna, we're gonna wield a hammer and say, hey, we're gonna cut costs and deliver it for a reasonable price, maybe. But I still like the idea of stop subsidizing energy and let's just build it unrestricted. Okay. OMB not allowed to report GDP above 1.8%. You cannot use tariffs. Well, why would tariffs be included in GDP? Shouldn't. Right? I mean, at the end of the day, it's just revenue. It's taxes, right? Again, is it a tax or is it not a tax? Whatever. But the point is, it should be characterized in the same category as taxation. But we shouldn't really count government spending as a guaranteed amount to GDP, right? That we're not producing anything. You're paying people. I mean, Keynes said, look, let's just print money, put it in bottles and bury it and have people dig it up for their wage. A lot of government spending has that mindset. It doesn't matter if it's productive. All that matters is that people get income and they can spend money. But there has to be a product that has to be generated. And unfortunately, most central planning does not produce a product that actually generates a return. It's a massive, massive problem. And frankly, most subsidized industries don't produce a product that produces an actual return. Bitcoin's money, though. So Bitcoin has no economic value except. So if you say, well, Bitcoin is just a electronic line item, right? You're right. That's why it's money, right? Money has no value. If money were oil, that's a problem, right? Because demand would increase with the economy. People would demand more oil. And now we're seeing the economic value of money shifting away from store of value and medium of exchange. So one of the principal definitions of money, and this is why gold has historically been money, is precisely because it has no economic value except for the fact it's a medium of exchange and store of value, which means what? It's rare, but not too rare, and it's divisible. Bitcoin's not too rare. Garrett shared an article. Some guy was like, going at him. He was starting to espouse the quantity theory of money. I used to believe that because I went to college and I was taught a falsehood. That, well, the money has to expand. The money has to grow in order for the economy to expand. Money is divisible, right? You don't have to grow the money supply to grow the economy. You do if your dear economy is based on debt, right? If it's not based on production, if it's based on debt, if your economy is based on production, what derives that? What drives the production? Savings drives production. Savings is the antithesis to debt. Interest rates go down as savings increase. As interest rates go down, companies borrow money and increase production. Everything comes back to savings as a driver for interest rate. We don't have a centrally planned monetary system. We don't have a central bank. You don't have a national bank, right? That ultimately is a driver for debt, not for savings. The Federal Reserve doesn't believe in savings. They believe if you save money in something called the paradox of thrift. They say if you save money, you're going to hurt the economy. Why? Because if you're saving money, you're not borrowing money. You might be paying down debt. That's precisely what they don't want. Everything they do is based on trying to expand the money supply, and they do it through debt. Yes, are there shadow banking means? Of course there is. Are there currency swaps? Does that create dollars out of thin air? Yes, it does, temporarily. If you engage in repo operations or reverse repo operations or big repo operations, and someone gives you a junky bond and you give them cash, at least overnight, and they just keep rolling that over and over and over, you have expanded the money supply. There is a shadow banking system that Garrett talks about, right? There's also just a good old banking system, banks trying to issue debt in the form of car loans, home loans, credit cards, et cetera, et cetera, et cetera. Borrow money for your furnace, right? It's not based on savings. Savings is the antithesis. We are electing to have a debt-based economy. Production leads to a savings-based economy. If you save money, you get rich. If you spend, you get poor and poorer. You may not get rich, but at least you're moving towards what? Self-sufficiency, which is precisely what the federal government doesn't want, right? They don't want self-sufficiency. They want reliance. They want power. At the end of the day, right? We know power goes in, it does not stay the same, right? And the more power the government has, the more it attracts people to want power, and we continue to see the envelope get pushed. They want you. They want all of you. Anyway, Dr. Richard Werner, Oxford created QE. Yeah, maybe not, right? Now, the Treasury's trying to engage in some debt buyback, strategic, and some people call that QE. That's not QE, right? Quantitative easing is what? The federal government issues debt, or anybody issues debt. The primary dealers, shareholders of our central bank, the Federal Reserve, buy the debt and they sell it to the Federal Reserve. The Federal Reserve gives them newly printed money, increases the monetary stock. And how does that monetary stock flow from the banks outward? It's through debt, right? And it comes with a multiple. So let's say there's $1 trillion in bank reserves. How much debt? It used to be 10x because we had demand deposits and they had to hold 10% in reserves. There are no reserve requirements for banks anymore in the United States. This 10 could be infinity for all we know, right? Not practically, but in theory. There is no limit in terms of 1 trillion of bank reserves that is created by the Federal Reserve buying debt, and then the ability to leverage that through loans and not having a reserve requirement. So this is how we get to, QE infinity, right? Just an infinite monetary growth, inflation. It's not good. Okay, so just understand is that as we look at what's going on in the market right now, it's kind of reflecting the reality that, look, we are trying to shift westward in terms of the emphasis in terms of manufacturing and investment. We've been seeing money just pour out of the United States for a few decades now, and it's been a disaster. Our debt's gone up, spiral, our personal, corporate, Government debt has just spiraled out of control. We consume more than we produce. We've seen the dollar lose its purchasing power, and you're seeing more and more people call attention to the fact the S&P 500 has not gained any value in 30 years. Okay, when you adjust for gold, for example, gold's a negative yielding asset. The S&P's not outperformed it in 30 years. It's a problem, isn't it? And we're going to see at least this year, and we're going to see maybe into the beginning of next year that trend continue, because we're not seeing real growth driving stocks. We're seeing monetary stimulus and debt, dollar devaluation, and debt driving stocks. All right, and we're seeing record high valuations right now. It's an expensive market at the moment. Peter says the poor subsidize the debt from the government. The poor spend, they purchase goods, the stocks I own. The more they print, the more I make. Well, that's not true though. How much have you made? So again, look at this, right? Just take the S&P 500. How much have you made? Let's look back here 30 years. Let's go max. I'm going to go back to 1997-ish in here. How much have you made? So in US dollar terms, 30 years, how much has the S&P 500 made? But Maury, does it matter if it's outperforming other foreign markets if it's not even doesn't even have a positive yield? So how much? So if we think about back here, for example, 91 to 680, that looks phenomenal, doesn't it? 91 to 680. If I went back here where I live in the 90s, mid to late 90s here, you're probably buying a home for about 90K. That same home today is probably going for 650K. Let's think about it for a moment, right? I mean, a home, right? A home is not an investment. If I just take the nominal terms, 30 years, a $90,000 home, 75 to 90 is now 650. Some areas are 750. Okay. Crazy. But that's home prices. We also had in the midst of this a financial crisis. We had a housing bubble, yada, yada, yada. But let's take something we know. The home is not an investment, right? It does not have any yield. So if we look at the SPY, now we're saying, look, let's take something we know. Gold, right? Gold is a negative yielding asset over time, right? Gold's a barbarous relic. It doesn't do anything for you. You hold it and do what? All gold can do is try to hold its purchasing power, but you still have to store it and protect it, right? So gold over time, unless you're willing to lease your gold out. There's a gold bank in Utah. I think the lease rate's like 3.17%. So you could lease your gold out and still get a return, a small one. But we're assuming that gold is not leased out, right? So I'm going to bring up the SPX. Okay. And we're going to look at this in gold terms, /GC. I'm taking the S&P 500 since when? 1996-ish right here. And we're trying to look at how the market has performed. PB says 12% annualized growth since 1971. But what happened in the 70s? What was the biggest problem in the 70s? Inflation, right? What about the 2020s? Inflation. This is the problem, right? When you buy the S&P 500, you're buying it in dollar terms. So you're buying the S&P in dollar terms. So the S&P 500 can go higher as the dollar goes lower. So if I compare gold, which gold does not produce a return, right? It actually has a negative return over time, but at least GC has a flat return. We're rolling the contract here, but the curve's pretty flat. So we're not really factoring a negative yield. We're just factoring a zero return in gold against the S&P 500. So if you exchange your S&P 500 shares for gold back in 1996, gold buys more shares of the S&P today. Well, actually, if you sell your gold and buy S&P back here, the S&P is lower today. Right? The point being is that the market has actually had a negative return, negative real return. 12% is not real. What this means is it shouldn't matter the return, right? The nominal return. What should matter is what? What should matter is the purchasing power, right? At the end of the day, that's what matters most. I remember talking to a doctor. This is probably around 2010. He did everything that the 12 percenters, which I was one of them at some point in the late 90s and early 2000s, the 12 percenters promised. Sell your practice for $1 million and you can take out 100K a year for the rest of your life. How has that worked out? The guy did it. He managed his practice. He sold it for $1 million. And now he bought an investing program because he kind of hit a little bit of a rust patch here. And he said, how am I going to make $100,000 without taking the risk of loss? How has that worked out for everyone? $1 million and 100K. Even if you were able to do that, 100K, what does 100K buy today versus 15 years ago? Is 100K about 50K right now? Probably. Right? What used to take you supposed to buy with 100K is now 50K. Right? But the problem is, even at that, the inflation had eroded this and that so much. 100K in 2010 didn't exactly buy what you thought it did back in the 80s or 90s, as all these financial engineers promised. Wealth and security, just get to 1 million, take 10% out a year. Doesn't work, does it? And it hasn't, because the market has not generated a real return in 30 years. So we can say that, oh, it works. It doesn't. Buying garbage companies, which most of the S&P 500 is a losing game. We can buy a lot of good, some bad. We just can't buy a lot of bad and a lot of losers. But if you're buying the S&P 500 or most indexes out there, most funds out there, guess what? You're buying a lot of losers, and that loses over time. Diversification does not work. We've been through 2 recessions, a financial crisis. Diversification, bonds, equities, yada, yada, does not protect you. You still saw 50% drawdown in 2000, and you saw over a 60% drawdown in the financial crisis here. What was your drawdown in during the COVID? Okay. I sound like my father. I just sound like my father as well. And again, it's interesting, but this is the reality. You have to produce something. You have to buy companies that produce something, not just financial engineering. Well, I got to pass the ball here to Corey. How are we doing, Corey?
Super good, Brendan. We're done off the support shelf. I've been giving y'all little trades here in the S&P and the Russell. Buy those little support shelves on a range day, and we're good to go in the future stream.
Great. Yeah, Peter asked when you buy gold. We did put on a gold trade yesterday. Trade,
Nice.
not
I
anyway.
like gold.
Hey, if you got money, if you got enough money, you should probably own physical gold too.
Yeah, it's
Right.
strong getting stronger. Same type of logic about the stocks that are strong getting stronger. There's a reason why things do so well, and they tend to keep doing well. Gold is among those, and a lot of stocks are the market itself. But yeah, gold is right there in that sweet spot of strong getting stronger.
We'll hop off. Let you radiate, Corey. Have a good one, folks. Thank you.
Appreciate it, Brendan.